Welcome to Momentum Monday. Today is January 2nd, 2023. Happy New Year, Howard, and everyone watching.
Sorry?
I say Happy New Year.
Happy New Year, buddy. What'd you do? You're out partying?
Yeah, I went to a friend's house, so it was pretty good. I played some volleyball today, even though it's a bit cold, but it was worth it.
Any resolution?
I don't really have any specific resolutions. I'm just will continue to do what I'm doing. So.
All right, take me through what you're seeing.
So we're looking at a monthly chart of the S&P 500. So each candle is 1 month. Each bar is 1 month. And as you can see in December, most stocks gave up their gains from November. Kind of almost across the board. Here's the Nasdaq 100, the small caps, semiconductors, financials. Maybe the only exception is biotech, which kind of went sideways again. But as you can see, biotech didn't really have a rally in
What about
October.
Healthcare XLV? What about XLV?
In October and November, just like the rest. XLV a little bit better than the rest. Typically,
healthcare is the only one that really large cap healthcare too.
Defensive sectors do well when people expect low growth in general in the market, but also TOT interest rates are perking up again. As you can see, TOT is starting to give back gains, which was a factor for tech to.
Yeah, it's going to be the one chart I would look at when you're done, but keep going.
Probably the only positive factor was that the US dollar continues to pull back. I mean, obviously still in an uptrend, but it's pulling back 3 months in a row.
And oil too.
Oil too. I mean, oil is kind of holding.
Oil got down to 70 in the 70s again.
Yeah, for the most part, oil was pulling back too, but for the past month, it's basically almost unchanged. Kind of. It's
well, that's the energy sector, but the price of oil went down to in the 70s. That's not really. That's just the ETF, isn't it?
Yeah, but it's a decent representation. It kind of bounced, Howard. It went down and it kind of bounced.
Okay, keep going.
So
you're on the US dollar. You were on the US dollar.
Yeah. So we mentioned that the US dollar is pulling back. This is typically positive for most stocks. But as you can see, it didn't really
help in December.
It didn't help in December, especially in tech.
That's a divergence. It had been kind of like trading together, and then that really diverted. Yeah,
tech has completely given back its gains. It's near its last year lows. So it'll be interesting to see January, February, if they can hold it, or they'll have another leg lower. I think the next earnings season starts in a couple of weeks with financials. Last earnings seasons, let's switch to weekly. Last earnings season, most financials actually rallied after their earnings. As you can see here, it was a pretty significant rally. So it will be interesting to see how this earnings season the market will react to banks' earnings, because interest rates are rising. Banks in general tend to make more money when interest rates are rising, as long as the economy doesn't enter into recession. So the way the market reacts, the way the market reacts to banks' earnings will kind of tell us if the market's really expecting recession or not. If you look at the 52-week high list, it's mostly either defense stocks like NOC or LMT in 52-week highs, or a consumer staple defensive stock, healthcare, as you mentioned, and probably half of them are biotech, just smaller biotech stocks setting up near 52-week highs. And obviously there are a lot of biotech conferences in January, so that might be a factor. But in general, the sector is holding better than the rest of the market. That doesn't mean that if the S&P has another leg lower, that those stocks are going to hold. But for the most part, if the S&P rallies, there is a chance that biotech might be among the leading stocks. Okay. What are you seeing?
Well, I think everybody knows how bearish, not bearish, just how the price action has taken me out of things. So in September and December, beginning of December, I just took whatever other stocks that I just felt like, whether it be Zoom or it's just I took any tax losses I could. This is the lowest exposure I've had. I'm growth, so this is the lowest exposure. I think last year was the lowest exposure I had, and I still had a bad year. And then based on December, again, I'm different. I think people know I moved a lot to T-bills for a year or so in October. So it's the lowest equity exposure I think I've ever had in my adult life. I don't know what will get me back into equities, not because I'm bearish, just because I'm busy. And I like the market. I like the seed market. And I just think there's so much more damage to come. So I'm going to share my screen here, Ivan, just pull up
All right,
two
let me stop sharing first, and then you can. Okay, now you can share.
I've read so many year-end letters, just kind of doing my job preparing. So here's the monthly, the 30-year bond. Can you see that?
Yeah, we can see it.
Yeah. So any kind of when you see that kind of trend break, I do think inflation won't be as bad as people think, but I think we're going to be living in some deglobalized, world where, we're dealing with wealth discrepancy. There's all kinds of new issues that are just, so I'm just super bearish just based on this chart. When you can go make 4.5%, almost 5% now 1 year paper, and you can go do 11 cap deals on simple real estate deals or 9 cap, I'll take that versus trying to make 12 to 15% in an index. And like I said, I like hard to pick stocks, and I kind of believe in indexes as you get older. So I think on this chart, rates are going to be a problem. Depends whose side you are for stocks for a long time. So that just is going to take. Again, I don't know. The Fed can do whatever it wants here, and that can change things, of course. But until the Fed gets back on side, and the good news is they're closer to being able to go back on side. They've raised rates so much that they have now room to switch. The problem is how much damage have they done moving this tanker, first not moving the tanker for so long and then moving it as aggressively as they can, especially as the world changes. So this chart, until this heals, this is kind of a trader's market in as we've been saying, and I'm not good enough. The second chart, and I've been saying this because I was, been selling Apple and all my, but just taking my equity exposure down. Can you see this one?
Yeah, we can see it.
Yeah. So, and I agree with Justin here. I don't know who he is, but there's technically kind of stuff I've been looking at. Relative strength, we've seen this with Amazon and Facebook and Netflix, and Microsoft's held on well and Apple's held on well, but you can just see the heaviness in large cap, the nifty 50 of this era, right? And Warren Buffett owns 40%. So yeah, he could take his exposure up in the FANGs as they come down. So that'll cushion. He's going to come after the FANG stocks because he's got so much cash, right? What he did to Apple, he can do to Microsoft and possibly Amazon. Like that's where, so their index buying will support these large cap tech, but I don't want to be in this crowded trade. And this is the most crowded trade of the last trend is the FANG. Okay. So, if you combine that with rates, I understand why people are hiding out in the big cap tech because they pay a dividend. It's going to be hardest to beat them, but I think this is going to be the year where, and I'll go back to you. I've been losing two charts. Let me stop sharing my screen.
Okay.
Just pull up the S&P. This is going to be the year where earnings are the problem, and I don't know how to. They throw around these numbers where you just S&P earnings are going to be 2,200 or something. Okay, whatever. I mean, I don't believe any of the numbers are right, but I just think based on what I'm seeing in my portfolio and what I see with my own eyes and ears, if you're not LVMH, if you're not selling to the 1%, like, it's going to be tough to meet your numbers. And I think, like you said, the banks are probably in the best position because of rates, to meet or beat. But that's not good for the general economy, this new economy that we live in, where people need to have 3 jobs, and the side hustles are tougher because Facebook isn't around to go grow your business. So it's the same stuff we've been talking about, Ivan. It's just I'm trying to narrow it down to a couple charts to explain why it's tough for someone like me to own stocks when I have so many choices to go get 5 to 12% on my, what I would consider equity money, my long-term equity money. So,
Yeah, I
for you, it's
completely
different.
understand. Yeah, completely
Yeah.
understand. If you're longer term investor, even just trend follower, if you probably need another leg lower in the S&P to just kind of consider to nibble something on the
Go
long
back to
side.
the S&P. I mean, the hot hands that I had that were calling this year are super bearish still, right? But again, they're trend followers too in many ways,
Yeah, there is a
right?
lot of recency bias, but there are some good
Yep.
reasons to remain bearish, at least in the medium term.
Yeah, I just think earnings are now the question. And again, like maybe everybody reports, and again, we'll have to see how people react to the news. Maybe everybody reports bad earnings and stocks go up. That would be a good sign. But I think you got to wait until you see some numbers here, because I've just listened to people complain about airlines and how fucked up travel's been, and the weather's been shit, even in Arizona. I don't know what it's been in San Diego. So it's kind of been a shit December for weather.
It's been cold the past couple of days, but it's not that bad.
It's been cold in Arizona all month, and they rely on these months to do a lot of business. So I just think generally earnings are going to be tough. A lot more layoffs in tech. And again, I'm not saying I'm bearish. I'm just saying I don't think this is priced in, and that's
yeah,
what we'll
you could be right. I think if you're
if I was good, I would have gone to higher cash, March, April, but I took an extra 10-15% hit. And now seeing where rates are, and they're starting to accelerate again to the upside. I don't know if the Fed cutting makes that much of a difference, and it doesn't look like they're going to cut until the second half of last year.
Yeah, probably not until March or April. Yeah.
And what does that mean if they cut? Like, are they cutting for reasons because the economy needs it, or are they cutting for a reason because they say their jobs done? So if they cut saying, hey, listen, we still think there's a problem, but we want to get in front of this and not create like a recession, that'd be bullish. But if they cut because the market's crashing, I don't know. And I don't feel like with the S&P, pull up the S&P again, and where the Dow is too, but where the S&P is, I don't think it's like they got to cut because the market's down. I mean, the market's still, they did what their job was in March 2020, which was saving the market. And so what I would say is, if going back to my first podcast in March 2020 when I started Panic with Friends, if you had told me, listen, let's flash out to December 2022 in March of 2020, and I'm going to give you a trade to do S&P 3800, you would have fucking loved that trade. You would have said, I'll take that trade. Give me that pain trade right now. So it's not like there's a lot of room for the market to go down where the Fed doesn't have to do anything. It's just my thought. And that's what's worrying me. It just seems like everybody's kind of trading the Fed and not trading the earnings and the general malaise out there. But that's it.
I agree. I mean, if you look at the earnings reactions, most of them are usually 1 to 2 days, and after that, breakouts have been failing for the most part.
Yeah.
And
the other thing that I will say is, in my industry, prices, like, again, I'm seed, but the prices aren't even close to where they should be. So, the private markets have lagged the public markets. So I still think prices are way too high in the seed market. And so I want to have powder dry, but those prices can adjust and like deal to deal. And my day job is to focus on that. So I'm super bullish on, if I invest in a company and I know the cap table and I know we're pricing it for US only, I can structure a deal. But it's very hard to price a company that's been priced in Web 2 pricing, like priced in an Uber world where the whole world is your customer. And I don't think it's that simple anymore. So it's like, if I can price a deal, which I can now, and talk to founders and say, listen, let's factor this escape velocity or the TAM of this market as being US market only or Southwest market only, then we can structure that deal. I don't feel that's factored into the S&P and to the NASDAQ 100. So hope I'm wrong. Like I said, this is great because I'm not betting against the market. I'm just like, I don't see a great reason as a trend follower to get long.
So the good news, is that your
I'm wrong.
Your expectations are very low, which means that probably many people's expectations are very low. So it should be easier for the market to surprise on the long side, eventually down the road for this year at some point.
Yeah, down the road eventually this year. I think people that buy stocks on dips here, should have an okay year for sure. It's just not a trade that I'm making for myself right now. So I think in a way you could have said the same thing, like March 09. If you had invested in startups or tech stocks, you would have done great, right? And so my bet right now with my money is I'm going to be wrong. I'm going to do it in an area where I have more control, right? But if I'm right about being long startups, then the market should also have good returns as well.
Yeah.
And the added benefit of being in the markets versus startups is liquidity. Don't get me wrong. There's less risk in if I'm right in startups, or you can structure good startup deals, then the indexes should do pretty well, but you get liquidity along the way.
Yeah.
How are you positioned?
I'm still high cash. I will remain very tactical and just short term for the time being. Just short-term swing trades, some intraday trades. This is what has been working basically for the entire 2022, and it's very likely to continue to work in the next 3 months. Just long and short, just doesn't matter. It'll be interesting to see in January if some of the worst hit stocks from last year are gonna bounce, because typically this is what we see. Yeah. Some of them already bouncing, like Tesla. Basically, that's a potentially bullish reversal candle last week. So I think it has.
Yeah, I mean, unless they truly, that felt like a little bit of like margin selling. It could even have been Musk.
Forced liquidation, yeah.
Yeah, it feels like, I didn't play that trade generally.
The stock like this.
Generally with high cash, I'll play trades like that, especially since I had a lot of smart friends saying the relative strength got down to like 5 or 6 there. Yeah. So saying,
these are the five worst performer on the S&P 500. I think these are stocks that you should be paying attention to. Generac.
Oh, okay. What the hell do they do? Standby.
Generac is so they make generators.
Huh.
I think there's always market for power generators.
Okay, so Generac, wow, 580. Okay.
So we have Match.com. And we have Align.
I remember selling that at like 70 on 80 on the way up. Okay.
Yeah, I mean, they were completely, as I said, the worst performer on the S&P. You have Align, you have Tesla, and then you have Silicon Valley Bank. I think these are the 5 worst performers, and some of them are kind of starting to, perk up. So typically when you especially for small caps, that this is very true, that were completely liquidated in the previous year. Some of them.
Yeah, even by guys like me, tax loss.
Significant bounces in January. So this is something that I will be paying attention to just as a short term.
Yeah. Will you share that list on your notes so I can share it?
Yeah, I'll mention.
Okay. All right. Well, how about, I can't wait to do these another year. I mean, it's going to be one of those years where I'm more of a watcher, no matter what. I feel like my opportunities, I've kind of planned my 2023 to be on the sidelines and focus on interest rate stuff and some real estate and some weird seed projects. I just know that my year is going to be tough, so I'm not look forward to doing these weekly, but I don't think
so. Maybe you'll be surprised positively. So let's finish with one last thing.
For me, it's only good if the market goes up, no matter what job I'm in. Like, I want the market to go up, but the wait for me is like, I gotta wait till there's way better price trends.
So let's finish on a positive note. Like, don't be afraid that you're gonna miss the next bull market. because it's a process. It's not an event. And even if you look at the price action in 2008, if you look at the price action in the first stocks that made new all-time highs in 2009, it was like Netflix and AutoZone and GMCR, which was later Green Mountain Coffee Roasters, which was later acquired by Coca-Cola. So they made the first stocks to make new all-time high, and then they went nowhere for months. So the bottom was in March, but it took like 4 or 5 months to really good setups.
Oh yeah, and you could have bought in 2010 and
at the 52-week high. So you don't need to be in rush. You don't need to be afraid that you're going to miss anything. Just pay attention to price action.
Yeah. And I think in bear markets, like I said, you got to think for people that have capital, indexes in a bear market are a much better way to look at markets. It's just so hard to stock pick when there's
because of the high correlations.
Yeah, it's very different. And that's a good point. Like the reason I do this is because it also helps with my private market investing. But looking at the markets every week, even if I'm very low, I think I'm like under 20%, like right around 20% exposure. But again, I have high exposure to high risk startups. So you're right. Like the bull market will show up. But what I worry about is like, first we had this story that there won't even be an end to this bull market because crypto is this whole nother generation. It was hard. I tried really hard to like understand it, and I still like NFT, the idea of it, but it still feels really, small and very, confined to some games and very still a toyish behavior for all the money spent. Then what's amazing to me is how fast the speculative fever is spread to AI, right? And how do you even play AI in the public market? It's like, so it's again this VC shell game of like, we've raised all this money, we get 2% either way, we got to put it to work, and that fever is still not gone. I think AI is pretty cool. It still feels much like a feature than for everybody to use, and that may be good for the economy, but it doesn't feel like it's something that like brings the whole market back up. I still think it's an interest rate world, and that the fact that everybody's thinking internally versus growth is a mindset that hasn't fully registered yet. All right, good job.
Let's finish with that.
And we'll see everybody next week, and Happy New Year.
Happy New Year. All right.